Good afternoon. This is Ken Long from Tortoise Capital with the review of the weekend trading reports for June 9th, 2013. We have a market that's in bullish volatile conditions on an annual basis using weekly RSI 14. We're at the very high end of neutral with 70 out of 100. Shorter term on a 10-day basis using the 10-day NDX, we're at 60 out of 100, so in the middle range of neutral. Looking at the market mosaic, price relative to the 200-day moving average is green bullish at 10.71%. The slope of the 50-day moving average has degraded to a yellow neutral at 0.47%. ADX has dropped down from 35 to 24.1, with bulls slightly in charge based on the buying of the last 2 days. We'll see on the chart. ATR percentage has increased to 1.30%, making it volatile and rising. The risk index is the 30-period moving average of the VIX divided by the 10-period moving average of the VIX, comes in at 0.89, or a risk off. The z-score of that reading of 0.89 is minus 1.46 standard deviations below the 5,000-day average. And so this is the last 90 days in a time series of that indicator, and we're at basically minus 1.5 standard deviations below the historical average. So that's been a place typically where volatility has started to reverse and leave the market. So this is volatility rising to what's now an extreme level. Blended monthly rebalancing portfolios, no changes until on or about 1 July. The holdings are financials, consumer discretionary, and healthcare in the 32 ETF portfolio. In the 13, it's small caps, mid caps, and diamonds. The theoretical exposure of ETF 2 is at 70%, and that's up from 60%. The model portfolio will remain at 70% exposed, and this is the YouTube channel for other videos of interest. Quick look at the portfolio holdings for the blended monthly rebalancing current readings. Diamonds, small caps, and then large caps in the 13 ETF. And you'll notice about half that set is on a cash position, with that mostly being the globals, while U.S. is strong. In the 32 ETF portfolio, also split between buy and cash. Mostly it's all the U.S. plus Japan currently, and then the globals plus commodities are on the cash positions. Looking at the market health check, let me zoom that up a little bit. Looking at the market health check here, vertical blue lines are 10, 20, and 30 days worth of look back. The horizontal purple lines are price targets that have been resistance in the past. And so right now at 168, we need to see price close above that and hold for us to believe that we might have another leg up here. Until that time, this is just tactical trading from the support level at 152 162, up to 168. Cleared the last hurdle on Friday. The horizontal red lines are support levels that have been support in the past and have been resistance in the past. Those are key price levels. Thin black line is the slope of the 30-period regression line through time, and it has pulled back considerably over the last 12 days, but still above zero. And you can see that reflected here in this is the 30-period regression line here, lagged 1 day. As part of the RAF regression channel, which is formed by the maximum excursion from the regression line during the look-back period. And what we have here is market found support around 151 at the edge of the river on the south. The river is a shaded blue area, which is the 30-period Bollinger Band plus or minus 1. The floodplain is the Bollinger Band plus or minus 2. And so what we had was an extreme move, has pulled back to the bottom of the river, found support, crossed the Bollinger Band mean, gotten through the first level of resistance here, and now we have a tactical trade up to 168, and if it closes above, with potential for really a 5% move above 162, which would get it up to 170 on a technical basis and still be within the general conditions of this upward bull right here. You can see the 200 period moving average just sneaking onto the chart here at the bottom of the price action. On a Williams percent R10 basis, we had some oversold conditions in here and are now back in the midpoint of the 10-day range. Percent price oscillator has still the jaws open to the downside, warning us ever since this crossover occurred in here, warning us of potential downside swings, but it is starting to improve on the basis of the buying action of the last 2 days from oversold conditions. On the ADX here at the top, you can see it's pulled down from above 35 now to below 25, so this is a weakening trend in the market. The last 2 days have brought the plus DI back above, so bulls are back in charge here on the basis of those 2 days, but this is really the point of tension right in here, that tactical trading between the purple line and the red line until we see it break out above. If we saw it break below 158, that would negate this entire last leg up, and then we'd be looking at a serious challenge coming down to the 200-day moving average. So that 160 is sort of the mark in or 158 is this mark in the sand at the boundary of the floodplain. So moving to the ETF2 regional report, 7 out of the 10 regions are on buy positions with respect to their moving average filter. 3 are on cash. That moves us up to 70-30 split in the theoretical model. Bull volatile market. The S&P at 54 is stronger than EFA. The global's at 48 by 6 points. So the U.S. is definitely favored right now. Inside the U.S., the indices have pretty much converged, but right now there's a slight advantage to the S&P, followed by small caps, then tech, then mid caps. The two strongest sectors are EWJ at 54 and the S&P at 54. The two weakest are Latin America and emerging markets at 30 and 34 respectively. The S&P spiders, strength in financials, healthcare, and discretionary. Only utilities are below their 4-month moving average. World market model, all of the U.S. is above average, all of Europe is above average, Japan still is above average, Asia less Japan, and emerging markets in Latin America are below average significantly in the red. China, Vietnam, and Malaysia are the winners in Asia. South Korea, the big relative loser right now. In the comparison of the U.S. versus global business sectors, the U.S. is ahead or tied with in all of the globals, with the exception of utilities, and their strength in the U.S. and globally with financials, healthcare, and discretion. Little change among the big winners in the ETF top 30. This is out of the database of 1,500 that we look at. Dominated by the winners from last week. Still, clean energy, solar, biotech, retail, more biotech, financials are sneaking in. Now, what I look for are those that are green on strength. That's a 3 and 6 month blended look back. And then consistency is a 10-week moving average of that weekly strength. So when I see green in strength and white in consistency, I know that money is going into financials and banks. Also, here's a semiconductor index, master limited partnership index, financials, buyback achievers, etc. So I'm looking for emerging leaders as well as the well-established leaders. That's how I read this chart. Looking at the Dow in the same through the same lens, Hewlett-Packard and Microsoft at the very top. Microsoft has made a nice run all the way from the bottom, just like Hewlett-Packard, but about 2 months after Hewlett-Packard, all the way to the top. They're being joined by Cisco and United Health, again, green and white. J.P. Morgan has found its strength and is part of the broader financial sector strength and is now green and white. The weakest ones in the Dow are still in the yellow, so that's a broad measure of strength of the U.S. large caps right now. Alcoa and Caterpillar, AT&T and IBM at the bottom. This IBM and AT&T that are yellow in strength but white in consistency, that's sort of like the polar opposite of what we looked at up here. When it's weaker than the long-term average, that's two that are decaying, if you will. Whereas ExxonMobil is early in its movement up because it's white than yellow. So that's one that's on the move up. Just reference for the most liquid based on average daily dollar volume of the last 30 days, and then those that are in green are exceptionally volatile intraday and thus make good intraday trading candidates. Shifting to the daily. No signals in channeling and overreaction. You can see the volatility has pushed it well up into the volatile range as measured by ATR percentage. Trendingness, the ADX has converged here with bulls slightly in the lead now. We have overreaction signal in Chevron. We have 551Ws in Chevron, IBM, DuPont, United Health, and Bank of America. On the ETF side, triple screen in silver, 551W and XLB materials. These symbols here are all ones that test out better than 2 to 1 on the just on the basis of trade location using the auto framer. And then the 10-day max pains are the ones that have lost the most on a percentage basis compared to their 10-day high. And the min pains are the ones that are the closest to their 10-day high, fully valued, if you will. And that's really where the leaders are. And these overreaction candidates are reasonable targets for one-day pops. If you see them outperforming the market on an up day in the market, that's a good low-risk entry. The Dow 30 tactical summary, only a couple dojis here. You can see the overreaction in Chevron, which is also a frog candidate. It's a 551W. It's number 5 out of the max pain range compression and tests out at 2.9 to 1 on the auto framer. Verizon and Johnson & Johnson are both dojis. Max pain range compressions are big 10-day losers, as you can see here. Nothing is in the green based on RSI2. Not surprising given the last 2 days of buying pressure. The ETFs, only 2 dojis in coal and Brazil. Silver was a one-day big loser, down 5%, and had a RSI2 value of 10. So silver's on sale at 20.86, and is also a triple screen candidate. The max pain range compressions, all except Japan, test out really well on the auto framer. So there's a lot of attractive candidates among those. Plus some other ones that are just nice on the auto framer basis. This is the 30-day regression line in black compared to the last 30 days. You can see how the last 2 days have brought it back towards the regression line. The blue line is the exponential best fit and is sort of a front runner for turning points in the regression line. Notice if you where the crossover occurs with respect to its 10-day moving average, and that happened 1.5 standard deviations above the 6-month average, so that was a potential intermediate term turning point up in here. You can see on a longer basis how that oscillator works. And now looking at the price with respect to the 200-day moving average, it has almost a 2 standard deviation pullback from the swing high, and now it has found support and is now just 1 SD above the average. So that's a place actually of health, longer term bull, because it can stay up in that area a good long time, and sets the basis for another 5 to 8% move to the upside. Now just some additional reference numbers. I won't talk to them except a few highlights here and there. Microsoft on a Z-score basis really outperforming its peer groups. Financials have been very strong, as you can see, with XLF all being in the white, compared to weakness now in Japan in the globals and shorter-term weakness in smalls and mids. This is one that bears some attention. I'll show you what we have on this. On the bottom side, we're looking at price with respect to the river. That's that 30-period Bollinger Band. The green line is the North Shore. The red line is the South Shore. I want you to notice that during this long bull run of about the last 120 days, price has been oscillating around the north shore of the river. And in the 1, 2, 3, 4 places where it has pulled back, it's held support above the river, and that's why the southern edge of the river, and that's why I really treat the southern edge of the river as the demarcation between bullish and bearish, and that I'm not surprised to see price oscillating around here. So finding support north of the southern shore of the river is a very favorable opportunity to continue getting long and buying on dip. So what we have right here is 1, 2, 3, 4 legs up and potentially building the fifth one. Now it's got to get above that swing high at 168, but if it does, a 5% move up here would bring it back, would get it up to 170 and be well within the normal oscillation fan, if you will, or the range fan of price during this punctuated bull market. So if you take the regression lines of 10, 30, and 90 days, so each one a factor of 3, and then you take the z-score of those slopes and then plot those with a plus or minus 1 band of normal, this is what you get. The red line is the 90-period regression line, and it is well above the 1.0 and has been holding steady throughout the length of this bullish move. This is where it had pulled back here, and now once it crosses zero line and starts marching up, that's really an indication of potential goodness, and it alerted us around 150 that, hey, things are looking good. It held support north of the river. You could actually treat this one and this breakout as the beginning of that bullish signal on the 90 from 145 to 165. And it is, even in this little pullback here, it has remained comfortably above the 1.0 z-score. So I take that as a very favorable long-term sign. The 30 period oscillates a little more. It got 2 standard deviations above the last 180 days here, up on this move. And so when it pulled back here recently, it's now back to about 0.5. That's a healthy pullback. And during that pullback, you can see the 10 went from 1.5 down to -1 and has now started to hook back up in the same places that it did the last 3 times in a row. In each case, it was a marker here finding support by the river. That's what I'm interpreting this one as. If you look back at the nearest neighbors, what then followed was a nice 5 to 8% move on the next leg up. And if the past is prologue, then we would not be entitled to be surprised if it gets back up to 170 on this leg, supported long-term by the 90, indicated early reversal here by the 10, and then with the 30 back inside the band of normal. Now there's reasonable room for it to move. So this is the voice of reason. It got overheated. Now there's room for it to find support and continue to go. If that were to be the case, we'd have a higher low on the regression line slope for the 30, and that would be very favorable and support the next leg up. So that's how I'm interpreting that. So I'll just flash through the rest of these. You can slow them down at your leisure, or look at them at your leisure on the weekend report. This ATR percent, I just noticed everything is much more volatile than usual. Green means very volatile with respect to the last 100 days. Okay, that's everything for this weekend. This is Ken Long at Tortoise Capital. Keep your powder dry and your risk measured.